Hello, and welcome to today's presentation on insurance functions. This is Business 635, Organizational Risk Management. My name is Cameron Carew, and specifically today, we are going to go over insurance brokers versus agents, insurance marketing, loss adjuster, actuaries, underwriters, and reinsurance. So what's the difference between insurance brokers and insurance agents? The brokers help the insurance applicant and insurance company complete an agreement. The broker is paid a percentage interest of that premium, whereas the agent provides the insurer can legally enter the contract with the agent. The agent must obey the instructions, basically create, bind, and terminate an insurance contract on behalf of the issuer or solicitor of business. Move into insurance marketing. Similar to marketing in any other industry right now, with traditional and e-commerce, with the main goal of minimizing advertising budgets while maintaining or growing the business. Turn our attention to the chart on the right, in 2023, we see Progressive experiencing growth in both the automotive and houseware sectors, while advertising expenses are down. Now, what this chart doesn't tell us is advertising expenses are down industry wide, yet with Progressive having a budget over $1 billion, they are seeing industry growth. The loss adjuster investigates and assesses the insurance claims. They're the ones that show up on site when an accident happens. They're appointed by the insurance company, so they want to minimize your payout, meaning they are the opposite of a loss assessor. Actuaries rely on financial and statistical models to assess and manage insurance agencies' risks. Key point in here is actuaries develop the rates based on their calculated forecasts, whereas the underwriter reviews all insurance applicants to determine exceptionally safe exposure. Otherwise, the underwriter will reject the application at that rate. So, utilizing adverse selection in differentiating which applicants to accept or reject. The goal is not to reject all or even risky applicants, but to allow the premium cost to reflect and protect the insurance agency. Reinsurance is something I think is the best kept secret. It's how to make a higher premium while exposing yourself to less risk. So I love using the Buffett example on insuring a portion of a Ferrari versus the entire Honda. So majority of Ferraris sit in underground parking garages and drive once a year, but owners always pay their insurance bill versus the Honda is consistently on the road with lowest possible premiums. You're getting way more risk and a lower amount of money in your pocket. So key findings I may have missed or went over a little fast is nowadays a life insurance agent is actually called a financial planner. That's just due to technology. They're not as used in that sense. The loss adjuster is for the insurance company, where the loss assessor is for the insurer. Actuaries investigate the risk versus underwriters determine if the risk is worth insuring. And reinsurance is similar to options hedging when talking about stocks. So, in conclusion, today we went over insurance brokers versus agents, insurance marketing, loss adjusters, underwriters, actuaries, and reinsurance. So, I'd like to thank everyone for their time and attention today. And hopefully, you learned a little bit regarding insurance.